Hey, good afternoon, everyone. Marty Mazzori here. It's Friday, the 29th of August, 2025, with your end of week snapshot. So, I've yet to score our PWA index. I haven't shared that as much with you lately. It was brought to my attention. Of course, I knew that. And the reason being is it's just kind of a boring topic these days. We continue to sit around negative 20 to 25. It kind of meanders a point or two up and down each week. Probably, if I had to guess, when I score it this weekend, we may gain a point or two. It essentially says that odds of a slowdown in the economy need to be respected. Let me repeat the phrase one more time. Bottoms are an event, tops are processes. And as I've shown you in the charts before, and we'll do it quickly today, one could really argue, at least from a technical perspective, that topping formations are being established here, or the topping process is going on. Easily could go on for months going forward. It's just a scenario where we have to be uber diversified and we have to do some smart hedging that allows us to remain participants. We've had a really good year so far, even relative to the U.S. equity market, even though we're not fully exposed to U.S. equities by a long shot. So we've made our gains in other parts of the world and in other asset classes with a lot less risk than just a full-on stock portfolio. But that doesn't mean that's going to easily continue going forward. This market's going to be very much a challenge. And we have to continue to tread lightly or softly, or let's just say play some defense until some of these signals and conditions that concern us abate, or the risk gets realized and we get valuations down to something reasonable, which they're not in the U.S. space right now. And I've shown you that. I thought about pulling that up again, but I do it a lot. And that's showing you the S&P 500 from three metrics that we track: PE, price to earnings, price to book, price to sales. And then we track the cyclically adjusted price to earnings ratio that Bob Shiller invented, and the Warren Buffett indicator, and dividend yields, and so on. These are all pretty much at historic and or all-time high record levels, and they're levels that you just don't get to see long, sustainable bull markets emerge from. But could we stay up here and above these levels and continue to kind of melt higher for months going forward? Yeah, and I think there's a not small case to be made. I've presented, the bullish narrative, which I think still sticks, and there's a bearish narrative as well. So anyway, without any further rambling, just accept that the risk is high right now and does not in any way mean that markets are going to crack tomorrow or even this year, but the risk remains too high for comfort. I'm just going to keep it light today. Let me just kind of run through some highlights of the data this week. We'll start with U.S. GDP for the second quarter was revised up to 3.3% growth. Initially came in at 3.1%. And when you square that with a 0.5% decline in the first quarter, the first half of the year grew at about a 1.4% annualized pace. So nothing really to write home about. Without the AI infrastructure build-out, the economy would be flat. So lots and lots of money. Virtually all the Capex that's being applied in the U.S. economy is going to AI infrastructure. I hope you all watched where we did a dive into the AI scenario today, or backdrop, versus the dot-com backdrop in the late 90s. Core durable goods grew by 1.1% month on month in July, and that was above the estimate of 0.2%. And June was revised up by 0.2%. So far, at least the first two data points I'm talking about do not suggest that the economy's in any kind of trouble, not necessarily great, but certainly not bad. And you'd have to question, in a still, I think, inflationary environment, why would the Fed be so quick to rush and cut interest rates? I think you have to question it. I'm not suggesting that they shouldn't, because our view is that the data is weakening enough to probably justify a September rate cut if the meeting were today. We still have 2 or 3 weeks to the meeting, and a lot of the August data has yet to come in. The personal consumption, expenditures, and income were released today, and they were relatively good, better than expected. The savings rate held at just above 4%. Wages and salary grew by 5.4%, and that is not disinflationary. Let me put it that way. August consumer confidence from the Conference Board fell to 97.4, but that was better than the 97.2 that was expected by economists. One-year inflation expectations, however, lifted to 6.2% from 5.7%. So inflation expectations are really elevated, considering the respondents in the Conference Board survey. July new home sales came in at 652,000. That was down a little bit, but again, ahead of expectations. Also with PCE comes their deflator, or the inflation statistics, and I did pull up that chart. Yeah, so here is, you can see year over year, the headline came in at 2.6%, the core, call it 2.9%. By the way, those are significantly above the Fed's 2% inflation target, and typically you get those down by raising interest rates, not cutting them. And having said that, again, right now I think a Fed rate cut of 1/4 point in September would be okay. If it were me, I would make the cut, and then I would not promise one going forward. I'd wait a little bit and see how the rest of the data come in, between now and get closer to year end. I call it 0.2% on a month-on-month basis. The University of Michigan consumer confidence, by the way, I pulled those up. So there's the Conference Boards that I already talked about. University of Michigan sits at really, really low historic levels. Current conditions, that component fell 6.3 points. One-year inflation expectations rose to 4.8% versus 4.5%, and so on. So just consumers not really feeling it, despite the fact that when you go out, it looks like people are still out there not hesitating too much in their spending. But the folks who are doing the heavy lifting remain the people in the upper income category and the people who tend to own things like stocks. Those who don't clearly are suffering in a not small way, particularly under the weight of the high cumulative inflation and a continued inflation rate that just compounds their issues right now. Of course, there's always lots that we can talk about in the geopolitical realm and so forth, assuming you all are catching a lot of the headlines, the firing of a Fed governor and the resisting of that firing. That's going to be determined in the courts and so on. I did see the market react to some of that. We saw inflation expectations actually go up, with the notion that Washington could indeed harness control of the Fed in theory and get them to cut interest rates. If you do that and the general economy is really not signaling it, you have a problem that could cause inflation, could be essentially more juice than the economy can sustain, and therefore inflation expectations rose, yields rose initially on the longer end, and that is really a signal that no, this is not something that would be good necessarily from a timing standpoint. There's a whole other conversation to be had about the history of the Fed and Washington working together. You could argue that happened around COVID with the bailout of the corporate debt market, or the holders of corporate debt. You could argue that explicitly it happened during World War II and into the early 50s. I've talked about that ad nauseum, and that was yield curve control, and that was an absolute coordination between the two. So history does show periods where they did get together, and I've suggested that over the next few years we're probably going to see something like that scenario, where the Fed provides the bid for treasuries to keep the yields low while we let the economy run hotter and essentially inflate away a well north of 100% debt to GDP ratio. And I won't explain that again. I've done that umpteen times, but I bet I will do it again, but just not today. Okay, so quickly, and then I'll close. S&P 500, 1-year daily chart. You can see new all-time highs, but fell off of that today. Pretty good down day. I think the S&P was down about 2/3 of a point. We'll see what goes on this next week. This is now a new sell signal. Just in the short term, look at the moving average convergence divergence. This is a very bearish negative divergence. Same thing with the relative strength index. You've seen these patterns lots. So, this just says that probabilities favor the market not really breaking through this, but hey, a little bit of good news, particularly on the trade front, could absolutely make that happen and defeat these technical patterns. The NASDAQ 100 index, similar, this bear flag did not play out the way it looked like it could. Closed just above this line right here that was pretty well established resistance. You broke out of it and then lost it. So a failed breakout is not a good thing. So a few percentage point decline, came back, tested it yesterday, and pretty much failed that test today. And we closed below the 20-day moving average. That's not a good technical setup for next week, but who knows what the news is going to be over the weekend, and we still have these negative momentum divergences. 10-year yield popped a little bit today, really right here, finding support at about 4.2. The dollar is just living on this 98 line right here. Gold is just incredible. Gold is now testing, actually exceeding that all-time high right back in here. Closed above this resistance. Big divergences, but this is a pretty impressive 6-day rally for gold. I do think the potential downside if something breaks in the gold narrative is not small. It's enough for us to spend a little bit of money hedging our position. I think I say it every time. We are super bullish on gold on a long-term trend basis, not so much on a near-term basis. So folks, I will leave it right there. Thank you, as always, for watching and listening. Hope you have a great weekend. I keep saying this, and I will, if going through my weekend exercises, I think there's something that you need to know, I will share that with you. If not, I'll talk to you again next week. Take care. Bye-bye.